Thank you very much, Stephen. I'd like to call upon Nick Bereshef, please.
Thank you. Good afternoon. It's a pleasure to speak once again at the Investment Outlook for 2012. Today, I'd like to focus on one important idea: the direct relationship between the rising price of gold and the rising levels of government debt that result in currency debasement. Since we measure investment performance in currencies, a clear understanding of the outlook for currencies is essential. In order to understand gold's relationship, it's important to understand that gold is money. It's not simply an industrial commodities like copper and zinc. It trades on the currency desks of most major banks, not the commodity desks. The turnover at the London Bullion Marketing Association is over 37 billion a day. The volume is estimated at 5 to 7 times that amount. Clearly, this is not jewelry demand. The world's central banks know gold is money. After decades of modest sales, they have become net buyers since 2009. This trend strengthened in 2010 and gained further momentum in 2011. They are buying gold as a counterbalance to their devaluing currencies. As money, gold has provided the most stable form of wealth preservation for over 3,000 years. It still does today. Gold has outperformed all other asset classes since 2002. This chart clearly shows that the U.S. federal debt, which is in purple, and the price of gold are now moving in lockstep. The red line represents the repeatedly violated government debt ceilings. This correlation is likely to continue for the foreseeable future. Based on official estimates, America's debt is projected to reach $23 trillion in 2015. And if this correlation remains the same, the indicated price of gold would be $2,600 per ounce. However, if history is any example, it's a safe bet that government expenditure estimates will be greatly exceeded, and the gold price will therefore be much higher. And it's not just the U.S. Most Western economies have reached unsustainable levels of debt, and that will be impossible to pay off. It's worth noting that the U.S. Federal Reserve, unlike the European Central Bank, can create money without restriction. The U.S. dollar has been the de facto world reserve currency for over half a century. The rest of the world currencies are essentially just derivatives of the U.S. dollar. Whether global debt is in euros or special drawing rights issued by the IMF, the Fed, and thus indirectly the U.S. taxpayer, will become the lender of last resort. Now, there are 4 possible ways to deal with this unsustainable debt. One is to grow out of it through increased productivity and increased exports. This is highly unlikely, as Western economies and even China are poised for recession. 2 is you can introduce strict austerity measures to reduce spending. This has the unwanted short-term effect of increasing unemployment, reducing GDP, and resulting in even higher deficits. Number 3, you can simply default on the debt. This will make it difficult, however, to raise future bond issues. And number 4 is to issue even more debt and have the central bank in question simply create whatever amount of currency is needed. Most politicians will select option 4. Since few have the political will to choose austerity, cutbacks, and full economic accountability, over simply creating more and more currency. Inevitably, they will choose to postpone the problem and leave it for someone else to deal with in the future. Last August, the world watched as the U.S. government struggled to come to an agreement on raising its debt ceiling and was forced to compromise and delegate the final solution to a supercommittee. Its lack of political will earned the country an immediate downgrade from the S&P, and subsequently the hastily convened supercommittee failed to reach a solution as well. In Europe, matters were even worse. Greece did try to write off half of its debt, but Germany and France reminded them that if they did, no one would buy their bonds. The British and the Irish implemented austerity measures that raised unemployment, reduced GDP, and resulted in even higher deficits. Italians watched their bond yields rise to 7%, while the tsunami and related nuclear incident deflected attention from Japan's financial problems as a temporary lull, because Japan has the highest debt to GDP of any of the developed countries. In order to compensate for slower growth, governments attempt to devalue their currencies and thus improve export competitiveness. This can lead to a global currency war that author and Wall Street and sort of Washington insider James Rickards discusses in his best-selling book, Currency Wars. The process is now well underway. A recent Congressional Budget Office report predicted that the U.S. federal government's publicly held debt would top an unsustainable 101% of GDP by 2021. Currently, the official U.S. debt is an astronomical $15 trillion. Yet this is only current debt. If the U.S. government used the same accrual accounting principles that public companies must use, unfunded liabilities like Social Security and Medicare make the real debt more than $120 trillion. This represents over $1 million per taxpayer. Obviously, this amount is impossible to repay. It's interesting to note that in almost every recorded case of hyperinflation, a point where inflation exceeds 50% a month, was caused by governments trying to compensate for slowing growth through full-throttle currency creation. This is exactly what we're seeing today. These events gave me the confidence to title my new book, $10,000 an ounce gold. The book connects the many trends that will be responsible for both rising debt and rising gold prices over the next 5 years. It'll be published later this year. To make matters worse, the irreversible macro trends that I discussed last year are still very much in place today. These include the added cost of retiring baby boomers, systemic unemployment due to outsourcing of Western jobs through globalization, and the rising oil prices due to peak oil. These irreversible trends will increase unemployment, lower GDP, reduce tax revenues, increase deficits even further, and force governments to borrow ever-increasing amounts of money. Governments find themselves between the proverbial rock and a hard place, as even austerity measures tend to negatively impact GDP. As GDP falls and debt increases, credit downgrades are likely to follow, resulting in higher bond yields, followed by even greater deficits. It becomes an unstoppable descending spiral. The loss of purchasing power against gold continued unabated last year. The US dollar and the British pound have lost over 80% of the purchasing power against gold over the past decade. The yen, the euro, and the Canadian dollar have lost over 70%. As we remind our clients, this is not a typical bull market in gold. Gold is not rising in value. Currencies are losing purchasing power against gold. And therefore, gold can rise as high as currencies can fall. Since currencies are falling because of increasing debt, gold can rise as high as government debt can grow. The sovereign wealth funds, as well as the more conservative central banks, will have little choice but to reallocate to gold in order to outpace currency depreciation. This is why some central banks, particularly those of China and India, accelerated their gold buying in 2011 for a third year in a row to nearly 500 tons, about 1/5 of annual mine production. While central banks have been net purchasers of gold since 2009, the real game changers will be the pension funds and insurance funds, which at this point only hold 0.3% of their vast assets in gold and gold mining shares. Continuing losses and growing pension deficits will make it mandatory for them to eventually include gold, the one asset class that is negatively correlated to financial assets such as stocks and bonds. When this happens, there will be a massive shift from over $200 trillion of global financial assets to the less than $2 trillion of privately held bullion. In considering where gold will be at the end of 2012, I look back to my first Empire Club speech in 2005. I said then it didn't really matter whether gold closed the year at $400 an ounce or $500 an ounce. The trends were in place to ensure it had much further to rise. 7 years later, we can say the same thing. It doesn't matter whether gold ends 2012 at 2,000 or 2,500, because gold's final destination will make today's price seem insignificant. These can be frightening times, but gold always offers hope. We may not be able to change global economic problems or government debt, but individuals can protect and even increase their wealth through gold ownership. Now, gold bullion ownership, not mining shares, ETFs, or other proxies of ownership, is insurance against accelerating currency debasement. We use the analogy that in case of a fire, would you rather have a real fire extinguisher or a picture of one? A number of people have approached me recently and said they wish they had listened 5 years ago. They feel they've missed the boat, that it's too late to buy gold. For those that feel that way, let me close with a Chinese proverb. The best time to plant a tree is 20 years ago. The second best time is today. Thank you.
Thank you, Nick. I'd like to call upon